Hello, everyone, and welcome back to the markets and welcome back to another week of trading psychology. This week, we are going to delve into something extremely important for probably most traders: FOMO. I am going to be sharing ways, strategies, techniques in helping you as traders to overcome FOMO. So let's begin. First off, we're going to talk about the definition of FOMO and its origins. FOMO, or fear of missing out, has become increasingly prevalent in today's digital age. Coined in the early 2000s, FOMO originally referred to the anxiety-inducing feeling of being left out of social events or experiences, particularly as a result of seeing others' activities on social media. However, its scope has since expanded beyond social interactions to encompass various aspects of life, including trading. The origins of FOMO can be traced back to fundamental human emotions and instincts. As social beings, humans have an innate desire for connection and belonging, and the fear of missing out on social experiences taps into the primal need. Additionally, our brains are wired to seek out rewards and avoid potential losses. This is a survival mechanism inherited from our evolutionary past. In the context of trading, FOMO arises from the fear of missing out on potential profits or market opportunities, driven by the anticipation of regret or disappointment if one fails to capitalize on them. So let's talk about how FOMO manifests in trading. In trading, FOMO manifests as a powerful emotional impulse that compels traders to take action based on fear of missing out on potential gains and so forth. This can take various forms, such as entering trades too early without proper analysis or planning, chasing after hot tips or trends, or overtrading in an attempt to capture every market move. FOMO often leads traders to deviate from their trading plan, risk management rules, as they prioritize the fear of missing out on potential profits over the rational assessment of risk and reward. Now, the rise of social media and online trading communities, some online trading communities, has exacerbated the prevalence of FOMO in trading. As traders, you are constantly bombarded with news, updates, and success stories from peers and influencers. Now, this creates a heightened sense of urgency and anxiety about missing out. The real-time nature of the financial markets and the rapid movement of information makes it challenging for traders to filter out noise and focus on their trading objectives. This can further fuel FOMO-driven behavior. Now, at its core, FOMO is a complex interplay of cognitive, emotional, and social factors that influence decision-making in trading. From a psychological perspective, FOMO taps into deeply ingrained cognitive biases such as loss aversion, social proof, and availability bias. This can all distort traders' perceptions. Traders may overestimate the potential rewards of a trade while underestimating the associated risks, leading to impulse and irrational decision-making. Emotionally, FOMO triggers a cascade of powerful emotions, including anxiety, excitement, and anticipation. This can all cloud traders' judgments. The fear of missing out on a profitable opportunity can override logical reasoning. The anticipation of regret or disappointment if one misses out on potentially a lucrative trade can fuel a cycle of emotional distress and reactive behavior. Socially, FOMO is perpetrated by the culture of comparison and competition prevalent in some trading communities, where traders often measure their success and worth against others. The fear of failing behind or being left out on the latest market trends can create a sense of urgency and pressure to keep up. Additionally, the fear of missing out on social validation or recognition from peers can drive traders to take unnecessary risks. Now, consequences, or the consequences of FOMO. The consequences to FOMO in trading can be profound, often resulting in detrimental effects on traders' performance, profitability, and self-worth. When driven by FOMO, traders are more likely to make impulse decisions and deviate from their trading strategies or plan. This can lead to a higher frequency of trades, increased position sizes, and greater exposure to risk. One common manifestation in FOMO or of FOMO in trading is the tendency to chase after hot tips or trends, entering trades based on fear of missing out on potential profits. This means that traders may disregard fundamental analysis or technical indicators in favor of following this trend. FOMO-driven trading often results in entering trades at less favorable prices as traders rush to capitalize on perceived opportunities before they disappear. The short-term gains obtained from FOMO-driven trading are often outweighed by the long-term costs of impulse decision-making. The emotional toll of FOMO can impair traders' ability to make rational decisions and stick to their trading plans, further exacerbating losses and eroding confidence. The emotional toll to FOMO in trading can be significant, often leading to stress, anxiety, and emotional distress. Traders who are gripped by FOMO may experience a roller coaster of emotions, ranging from excitement to fear and frustration. The fear of missing out on a potentially lucrative trade can override logical reasoning. This is not a good thing. In the long term, succumbing to FOMO in trading can have profound implications for traders' success and longevity in the markets. Traders who consistently make impulse, emotionally driven decisions are less likely to achieve sustainable long-term success. The consequences of succumbing to FOMO in trading are far-reaching, encompassing both short-term impacts on trading performance and profitability and long-term implications for overall success and well-being. By recognizing the emotional toll of FOMO and implementing strategies to reduce its effects, you as traders can create a more disciplined, rational approach to trading, and this will maximize your chances of long-term success in the markets. So let's start by identifying some of these triggers of FOMO. One of the most common triggers of FOMO in trading is high volatility in the markets. When market volatility spikes, prices can fluctuate rapidly, creating a sense of urgency and excitement amongst traders. Now, this heightened state of uncertainty can trigger FOMO as traders fear missing out on potential profit opportunities. The fear of missing out on a big price swing or a lucrative trading opportunity can lead traders to abandon their trading strategies and chase after short-term gains. This can often result in disastrous results. High volatility can exacerbate emotional responses and amplify the fear of missing out on profitable trades. Traders may feel pressured to act quickly to capitalize on perceived opportunities. However, trading in volatile markets requires a high level of skill, discipline, and risk management. Traders who succumb to FOMO during periods of high volatility are more likely to experience emotional losses, distress, as they struggle to keep up with rapidly changing market conditions. Another significant trigger of FOMO in trading is the influence of social media on traders' behaviors and decision-making. In today's digital age, traders have access to a wealth of information and market commentary through social media. While social media can be a valuable source of market insights and analysis, it can also fuel FOMO-driven behavior by amplifying the fear of missing out on profitable trades or investment opportunities. It's essential for traders to recognize the influence of social media on their trading behavior and take steps to reduce its impact on decision-making. This may involve limiting exposure to social media during trading hours, filtering out noise and irrelevant information, and maintaining a healthy mindset towards recommendations. By focusing on your own analysis and sticking to your trading plan, you will avoid falling victim to FOMO-driven trades. So let's go on now. One of the most fundamental triggers of FOMO in trading is the fear of missing out on profitable trades. This fear can arise when traders see other traders profiting from a particular trade or market movement. Whether it's a hot stock, a trending cryptocurrency, or a sudden spike in the market, the fear of missing out on profitable trades can be particularly destructive. Traders may fear being left behind by the market or missing out on the next big opportunity. However, chasing after short-term gains without regards for the underlying fundamental or long-term prospects of an investment can be a recipe for disaster. So, in conclusion, high volatility, social media influence, and the fear of missing out on profitable trades are common triggers of FOMO in trading. By recognizing these triggers and taking steps to reduce their impact on your decision-making, you will avoid falling victim to impulse trades driven by FOMO. Self-reflection to help identify triggers. Self-reflection is a powerful tool for identifying personal FOMO triggers, and it helps to gain insight into emotional responses and decision-making patterns. So, here are some self-reflection exercises to help you begin to identify your own FOMO triggers. Now, the first one is journaling. It's important for you to set aside time each day to journal about your trading experiences and emotional reactions. Reflect on recent trades, market events, and any instances where you felt the urge to act based on fear or the fear of missing out. Write down your thoughts, feelings, and observations, and pay attention to any reoccurring patterns or triggers that emerge. By documenting your experiences, you'll gain a better, deeper understanding of your FOMO triggers and the impact on your trading behavior. Again, mindfulness meditation. Practice mindfulness meditation to create awareness of your thoughts, emotions in the present moment. Find a quiet space, close your eyes, and focus on your breath as it flows in and out of your body. Notice any thoughts or emotions that arise without judgment. Just allow them to come in. And as you create mindfulness, you may begin to notice subtle signs of FOMO, such as feelings of restlessness or anxiety. This can help you identify your personal triggers more effectively. Next, we have reflective questioning. Ask yourself questions to deepen your understanding of FOMO triggers. For example, ask yourself, what situations or market conditions tend to trigger my fear of missing out? Is there a particular asset class or market sector that I find myself chasing after? Am I more susceptible to FOMO during certain times of the day or week? By asking yourself these questions, you'll start to uncover underlying patterns and tendencies that contribute to your FOMO-driven behavior. Seeking feedback. Seek feedback from mentors, networking, people that you trust. Share your experiences and observations with others and ask for their insights and observations. Sometimes an outside perspective can provide valuable insights into patterns and triggers that you may not be immediately apparent to. Be open to constructive feedback and willing to explore new perspectives on your trading behavior. Self-reflection is a valuable tool for identifying personal FOMO triggers, and it will help you to gain insight into your emotional responses and decision-making patterns. So by journaling, practicing mindfulness, asking reflective questions, and seeking feedback from others, you'll be able to deepen your understanding of FOMO and also develop strategies for managing it more effectively. Now we're going to delve into strategies to reduce and even overcome FOMO. Establishing clear trading goals and objectives is foundational to success in the markets. By defining your purpose and vision for trading, you can create a roadmap that guides your decision making and keeps you focused on long-term goals. Begin by clarifying your financial goals, whether they involve generating supplemental income, building long-term wealth, or achieving financial independence. Next, outline specific objectives that align with your goals, such as achieving a certain level of performance or income. These goals and objectives serve as a compass that directs your trading activities and helps you to stay on course. Setting realistic targets and risk management boundaries is essential. Before entering any trade, carefully assess the potential risk and reward and establish clear profit targets and stop loss levels. By defining your risk-to-reward ratio and adhering to strict risk management principles, you can minimize losses and maximize profits. Additionally, consider the impact of position sizing and leverage on your risk exposure and adjust your trading strategy accordingly. This is to ensure that your risk is within manageable limits. Aligning trading decisions with your long-term trading plan is critical for maintaining consistency and discipline in your trading approach. Develop a comprehensive trading plan that outlines your entry and exit points. Remember that consistency is key to success in trading. And by sticking to your plan, you can build a solid foundation for long-term sustainability. Practicing patience. Practicing patience and discipline is essential for riding through the ups and downs of the financial markets successfully. In a world of instant gratification and constant connectivity, it can be tempting to act impulsively in response to market noise. However, successful traders understand the importance of waiting for confirmation signals before entering a trade and avoiding impulse decision-making. So by creating patience and discipline, you will be able to resist the urge to chase after every market opportunity. Utilizing trading rules and techniques is another effective way to manage risk and optimize your trading performance. Implement stop-loss orders to limit losses and protect your capital. Additionally, consider scaling in and out of positions to manage risk and maximize profits. By employing proven trading techniques and adhering to established rules, you can enhance your trading efficiency and effectiveness, ultimately leading to improved results and greater consistency in your performance. Next, we have embracing fear. Embracing fear as an opportunity is a mindset shift that can transform how you approach trading and overcoming FOMO. Rather than viewing fear as a negative emotion to be avoided or suppressed, learn to embrace it as a signal to reassess your trading strategy and make adjustments as needed. When faced with fear or the fear of missing out on a potential trade, take a step back and objectively evaluate the situation. Consider whether the trade aligns with your overall trading plan and risk tolerance, and be willing to accept missed opportunities as part of the trading process. By embracing fear as an opportunity for growth and learning, you'll be able to transform FOMO from a hindrance into a catalyst for improvement and success in your trading journey. So in conclusion, establishing clear trading goals and objectives, setting realistic profit targets and risk management parameters, aligning trading decisions with your long-term trading plan, practicing patience and discipline, and utilizing trading rules and techniques, embracing fear as an opportunity are essential components of a successful trading mindset and strategy. By incorporating these principles into your trading approach and consistently applying them in your decision-making process, you can enhance your trading performance overall. The potential hidden reasons behind FOMO. To truly understand and effectively address the phenomenon of FOMO, the fear of missing out in trading, it is pivotal to examine the potential underlying causes that drive this behavior. While FOMO often presents itself as a reaction to market events or social influences, its roots often run much deeper, tapping into deeper psychological factors and limiting beliefs that shape traders' perceptions and actions. One significant underlying cause of FOMO in trading is this: insecurity. Many traders experience feelings of inadequacy or self-doubt, which can lead to a constant need for validation and affirmation through trading success. Insecurity can manifest as a fear of being left behind by the market or missing out on profitable opportunities, driving traders to act impulsively in an attempt to prove their worth or competence. Addressing feelings of insecurity requires creating self-awareness and self-compassion, acknowledging and accepting one's limitations, and reframing trading success as a journey of growth and learning rather than a validation of self-worth. Another common underlying cause of FOMO is the fear of failure. Traders who fear failure may be driven by a deep-seated need to avoid disappointment or even embarrassment, leading them to chase after potential opportunities. This fear of failure can be rooted in past experiences of loss or rejection, and it creates a sense of urgency and anxiety that drives impulse decision-making. Overcoming the fear of failure involves reframing failure as a natural part of the learning process, embracing risk-taking as an opportunity for growth, and adopting a growth mindset that focuses on progress rather than perfection. Limiting beliefs are also another significant underlying cause of FOMO in trading. These deeply ingrained beliefs about oneself, the markets, or trading success can create mental barriers that prevent traders from taking decisive action or pursuing their goals with confidence. Common limiting beliefs include beliefs about scarcity, unworthiness, or the fear of failure. These can all fuel feelings of FOMO and undermine trading performance. Overcoming limiting beliefs involves challenging and reframing negative self-talk, creating a growth mindset, and building a sense of abundance and possibility. By recognizing and addressing feelings of insecurity, fear of failure, the desire for validation, and limiting beliefs, traders can develop greater self-awareness, emotional intelligence, and psychological resilience. This in turn allows them to make more informed and rational trading decisions, helping them to navigate market volatility with confidence and achieve long-term success. We have now come to the end of this video presentation. I hope you have found this interesting and valuable. If you have any comments or questions, please write them or type them in the comment section below. I hope you found great value. I hope you have an amazing week in the markets, and I will see you next week. Thank you.